Hello and welcome everyone to the real episode 25. I jumped the gun a bit last week thinking episode 25 was last week. It's actually right here today. We have episode 25. My name is Andrew Cox. I'm here with Mr. Kevin Hill. We're here to discuss where finance meets freight and everything in between. And we have a lot of finance to discuss today, Kevin, don't we? It is the beginning of earnings season.
We do. It's just that special season. There's no sports. So this is the only season that we have are earnings seasons.
I know. Somebody needs to open up a booking line. Somebody needs to open up a betting book so somebody can get their betting.
Well, I think it's called the stock market.
I know, but it'd be more fun if we. I guess they trade options and stuff. But
yeah, trade options.
All right, it'd be fun. Yeah. Either way. All right.
That's one thing that we haven't had since quarantine is discussions about options. And, I'm kind of missing it a little bit.
And we went from hating ourselves in our group there. Everybody talked about options nonstop in our little finance group in the corner. But now, I'm kind of missing those boys talking options all the time. I'm with you. Well, let's jump right in. An update to last week's long short, as we've been doing. Last week we talked about retail sales. They came out on Thursday. We were asking whether we thought it would be down double digits when the number came out. The consensus was about 7% down. We both went long. We both thought that it would be down more than double digits. It came in a little bit less than that. It was actually down 8.7%, but that's an understated number, isn't it, Kevin?
I think it is because it's survey-based data, and we went over earlier today on the coronavirus freight market update that we do at noon, Tuesdays and Thursdays. But with that, it's a survey. So it's survey-based. It's taken basically in the middle of the month. So that's a reflection of the middle of March, and it got worse since then. You have this great graph from JP Morgan, real-time data on credit card and debit card transactions. And what do we have there?
Yeah, they didn't give an aggregate number, but they did break it down into 4 categories. They had travel and entertainment, which were down 100%. They had retail, which was down less than I thought. It was only down about 15 or 20%. They also had restaurants and whatnot. That was down significantly, something like 75 or 65 or 70%. And then we also had purchasing from grocery stores and supermarkets, and that was up roughly 10 or 15% as of the end of March, but it had a big surge there at the beginning of March when everybody did that panic buying.
It did, and the graph wasn't too detailed, so it's hard to tell if it was 50% or 10% or 20%, but there's quite a few takeaways from that, and I think that's what we'll see going forward in the April numbers whenever those come out in actually, it would be
coming out the end of the month, beginning of May.
2 or 3 weeks.
Yes. We had a lag in March where all of the surveys were taken at the beginning of the month, but now we're going to see a true impact because these are taken at the beginning of April, in which things are really bad across all sectors of the economy. But we'll get into some more of the economy here in a bit. Another continuation of a new segment we had was One Good Piece. Again, this is my quest to find one good piece of data in this time of horrible data, and it is, let me tell you how difficult this is. It has been a difficult task. Last week we talked about Wuhan auto sales, so it was a couple of, especially actually they were fine car dealerships. I think they were Audi and Mercedes, but either way, there was a bunch of dealerships in Wuhan, the original epicenter of COVID-19, that were saying that that they had already returned to pre-crisis levels of auto sales and auto demand. And there was a bunch of read-through there, but for me, I took it as it could be a little bit of good news that that durable goods demand could snap back pretty quick.
It is. It's a glimmer of hope, or green shoots, as they say, as economists say. Green shoots that if auto sales came back so strong in Wuhan that it could happen here. And you know what? It could.
It could. There's other read-throughs. It could be that Chinese people genuinely just think that riding in cars right now, riding in a personal car, is safer than riding public transport because of the social distancing and everything, which that could be true either. But this week we've got another one good piece, and it's truly sad that this is my one good piece because I've had such trouble finding one that my one good piece is not so much a good thing, it's that bad things have stopped happening, and that's in our freight volume. So the outbound tender volume index has seemed to stabilize, Kevin. We've only fallen 2% in the last week.
So it spent most of March running up 30%, which is a record high, by far a record high. And then it spent most of April sliding down off a cliff back to year-over-year levels, and then down, I think, we're
another 10 or 15% down after that.
So basically we were 14%, I think, on Friday. We're not quite at 14% anymore, which is good, and we've seen some leveling off. Let's hope that this trend continues and maybe the worst is over right now.
Yeah, it's kind of bleak to celebrate just a slowing of a decline, but that's what we're celebrating right now. The good news is there are some states that are opening back up this week. Even Georgia has announced that they're going to try to open up some businesses. I'll keep my opinions of whether they should or should not out of it, but it is a good sign for freight volumes.
Yeah, it is a good sign. So you have Georgia's Tennessee, or is Tennessee?
Tennessee is opening up some things. I think their plan is a little less
bit
concrete.
More slower than, but I think Texas is actually opening up as well, kind of on the same timeline as Georgia. So that's two large states that will be entering. Hopefully, demand will pick up there. As far as a real macro look, you still have New York and California, kind of the West Coast and East Coast, where the population centers are going to be. They're going to be closed much longer than Georgia and Texas.
So where do you stand in the Strickland-Fuller debate? What is their number, 9,300? And I think you guys had it on the coronavirus.
May 15th.
May 15th,
yeah, on the coronavirus freight market update, Craig called in, our CEO here at FreightWaves, and talked to Zach Strickland, who's our Director of Business, or Director of Freight Market Intelligence.
There you go.
And they had a wager May 15th that OTVI would be above 9,300.
Yeah, where do you stand?
I would take the short end of that.
Okay.
So I'm probably in Strickland's camp.
I am as well. Team Strickland, here we go.
Yeah, yes.
All right, so you want to
And the reason for that is that there's just a lot of unknowns.
So much
out
uncertainty
there. I think a lot of the economy won't open up until the end of May. Now, whether that's the East Coast, West Coast I just mentioned, or major retailers that have been closed, they're closed before the states closed down, I think because of liability issues and really sales revenue questions, that I think they're going to be later to open up than the states.
Yeah, we spend a lot of time trying to decipher, what percentage of freight volumes is retail and what percentage of it is X, Y, and Z. So this is going to be a testing of those theses on how much gets opened up when it comes back online.
It will, and it feeds back into Wuhan too, and the auto sales, right? So if auto sales in May are depressed and don't really recover anything, or at the bare minimum, then you're going to see below 9,300, if not. Oil, I'm just giving up all hope on.
Yeah.
Negative. It closed yesterday at negative $37 a barrel.
Yeah, the
had to explain to my father how that could happen.
Yeah, it was a head scratcher.
Yeah, it's almost like if you had to call someone to haul away your junk, and they're going to charge you to haul away their junk or your junk to the junkyard. You're paying someone to take that contract off your hands. And what we've seen in Western Oklahoma and Western Texas over the last few months, too, is natural gas has actually been negative at the terminals and wellheads out there. So you have to pay people to get it out. Get it off your hands.
So we'll have that. We'll have a full oil debate here about the full recovery of oil prices here in a couple minutes. We'll do that towards the back end of the show. But let's. It is earnings season. Let's tisk the season to hop into some of the earnings. We've only had a week or so of earnings reports, so we haven't had that many companies report yet. Most of them will be coming up in the 2 weeks. But we have three in particular here that we're going to discuss. The first one is J.B. Hunt. So let's jump right in. I mean, they had really solid results given the volatility in Q1. Here, I'll rip off some numbers for you.
Yes.
So they had a couple one-time charges that if you actually pull out the one-time charges, they had year-over-year growth in EPS. If you leave those in, they were down 3%, so it's still a solid number. And those one-time charges were $12.3 million, which was actually for increased employee compensation to get through COVID-19, which is great on there.
That's part of the $500 bonuses to drivers, right?
Correct.
As part of that incentive plan.
Correct. And then they had an $8.2 million accrual that they owed to BNSF, and they had $3 million in expedited compensation to early executive retirement. So, but if you pull those out, you really have a really great quarter for J.B. Hunt.
Yeah, J.B. Hunt is well positioned to go through, especially, March. March was a good month for a company like J.B. Hunt because even with intermodal volumes plummeting, that they still increased the revenue because they have a nice corner of the business on intermodal. Truckload, dedicated, final mile was big as well, and brokerage. where you saw, constricting margins on up volumes, which we'll see the opposite of going into April is going to be far, the volumes could be far less, but the margins should expand, especially I think they're up to about 75% contract business in their brokerage. So as those contract rates remain stable for some length of time, it might be very short, it might be a little bit longer than we might think, but as far as those contracts, is be less volume, contract rates are going to stay about the same, and the spot rates have, as you detail every Thursday, and the THL Supply Chain Pricing Power Index, they're plummeting right now, which is horrible, but that is what's happening. So you're going to have an expanding margin. I think their margin got cut from...
Yeah, it got cut down. Last quarter, sequentially, it was 10.6%. It's down a whole percentage point, down to 9.6%. But compared to last year, it's actually down from 16.5%. So it's a really big year-over-year declines in the operating margin. But they still are claiming some cost to rolling out that 360, to really scaling up the 360 marketplace. So that's still not at full scale. They're not really reaping the benefits quite yet, but they will here in the coming years.
Yeah, and you would think that margins would contract, especially in March, right? When you have record levels of freight moving to restock, everything's expedited, everything has to get off the docks and get into the store shelves. That basically, when you have contract rates, spot rates are going to come up, your margins are going to constrict. That's one part of the cycle, right. And second quarter will be probably a different story.
Yeah, it'll probably be the quickest switch of cycles, the quickest peak to trough or trough to peak rather in this cycle that we've seen in recent history. But I just said as you mentioned a minute ago, that J.B. Hunt's really well positioned to move forward through quarter two. Nearly 65% of their operating costs are represented by purchased transportation and fuel expense, which are both falling fast and they're both variable costs. That's that cost structure that they'll probably be able to draw down. And they've also got a big revolver that they haven't really touched. They have got plenty of liquidity to make through it. So yeah, they're pretty well positioned to get through this.
Yeah, they definitely are. They're kind of the bellwether, and they're always the first to report, and that's a prime position. So everyone has to follow in their footsteps. And if you're wondering what we're talking about, the cycles. There's 4 cycles to the freight brokerage. We have a paper out, Freight Intel Group here at FreightWaves, and you can find that with a subscription to Sonar or to Passport.
That's right. And so that's overall. Let's put our wrapping touches on J.B. Hunt. A really good quarter, Q1. Q2 is likely going to be a little bit more difficult for them, even though they'll have falling volumes. I mean, at least the early start of Q2 will likely be a little bit more difficult for everyone in the industry. You agree?
I don't know how I could disagree.
Okay, because you gave me your disagreement look. So
no. I completely agree. Did they have any guidance? I can't remember if they. Or did they kind of withdraw guidance? Which I think is going to be a common
they withdrew
theme.
Guidance. It is a common theme. We've seen that. We've seen that from Kansas City Southern, which is the next company we're going to talk about. You're going to see a lot of companies. If they don't pull guidance, they'll just say nothing, kind of like XPO did, and just kind of expect the analysts to draw down their expectations. Which we'll talk about XPO as the third company, but. As I mentioned, here is Kansas City Southern. They had an incredible first quarter. They are just continuing to reap the benefits of this transition to PSR. They were one of the later ones to do it, but they are really doing an incredible job with PSR. Their Q1 EPS was up 30% year over year, which absolutely smashed the street estimates by more than 20%. They just continue to demonstrate significant efficiency gains from PSR. Their train velocities were up 26%. Their dwell time at terminals was down 9%. They're running much less trains at a much higher speed, and they're doing it really well.
Rails are a fascination to me because they're the only ones that continuously decline in revenue. Yeah. ORs go up and they become more profitable, and EPS goes up, and basically, you okay?
Yeah, I'm fine.
Okay, and then they just crush their numbers every year on declining business.
I think there's a point to make about this. People have this flywheel has come into business discussion, at least in the last few years for me, that I hadn't really heard about it. But this PSR flywheel is something to make mention of because it's absolutely fascinating to me. If you run fewer trains, you have longer lengths, you have fewer delays because of that, you have fewer mechanical problems because you're running less trains, you have reduced fuel consumption because you're running less trains, you have less equipment purchases, all of these things, and that ultimately leads to a lower headcount.
It does. I see their OR, operating ratio, was 59.7% this quarter.
Lowest in company history.
How much lower can you go?
I know. I mean,
you still are a
60%.
railroad company. I mean, you can't have SaaS, software as a service type of margin. You can't have 90% ORs, can you?
I mean, it's just it's bonkers. It's 60% OR on a company this size. But nevertheless, all of this good news, they have withdrew guidance, as we just mentioned a moment ago. They've withdrew guidance for everything: revenue, EPS, operating ratio. But just like JB Hunt, they're also one of these bellwethers. They're pretty well positioned. They've got a lot of liquidity, and they've got a lot of variable costs that they can draw down. Like as you said, this is just a fascination that they can get lower volumes, they can get lower revenues, and yet they still keep bringing in consistently higher operating income. They're able to cut costs in line or lower than with volumes. It's just awesome.
And they have a really healthy Mexico piece of their business going back and forth on the border. And I believe Mexico's auto manufacturing facilities and most of their manufacturing, maquiladoras is what they call them, are basically offline until the end of May. Is that right?
Yeah, we talked about that.
Yeah, so there's going to be a very slow growth. So April and May are going to be tough months, but it's a railroad, so they probably have a way.
Yeah, they've got so many levers they can pull to draw down costs and make sure that they're still well positioned, which is impressive. Another a less impressive note is XPO. We can talk a little bit. We're actually going to talk more about the letter that Brad Jacobs wrote to shareholders rather than so much their quarterly results. Because I think the letter, one, because Brad Jacobs is one of the best in the industry, and we have a lot of respect for him here at FreightWaves, but because the letter has a lot of read-throughs to the rest of the industry. So Brad Jacobs, again, released a letter to his shareholders last Thursday, and he wrote that it would be a lost year for the industry. Quote, lost year. Kevin, do you agree with him? Do you think it's going to be a lost year?
Yeah. I think everyone should be probably somewhat in agreement with that. It's going to be tough to climb out of this. I mean, basically, it's not going to go on for months of getting worse and worse, but climbing back out of this, no matter what route we take, is getting back up to near, say above 90% of the economy that we had before is going to take months upon months, and probably won't get here until 2021. I think I think in that respect, that's a description of a lost year. And I think he's right with getting out ahead of it, acknowledging it, and preparing for the future.
One thing he did not acknowledge was their guidance. They didn't make any changes to it. They kind of just let it go and allowed the analysts to change their own expectations, which every analyst has cut guidance for XPO and for pretty much the entire industry because, as he said, it will be a lost year. The thing about LTL, the thing about XPO, that it's kind of difficult. It's kind of difficult to comp the drawdowns in tonnage. We only really have one instructive comparison there, and that's 2008, 2009. And if you want to look back at XPO's predecessor, Conway, the LTL company they bought a couple years ago, they saw tonnage fall down at nearly 13% in the first quarter of 2009, and ODFL, their biggest competitor, saw nearly 15% drawdowns. Kevin, do you think that we're going to see that level of drawdown in LTL tonnage for XPO, or do you think it'll be a little bit less?
I think it's going to be pretty comparable. I do. And Final Mile is separated from that, right?
Correct. Yes.
So I do think that we, on the LTL side, we probably will see a sharp decline, even though e-commerce is everyone's positive note. I think you'll still see the drawdowns.
Yeah, I don't know if we quite get to that level, but I agree. I think we probably see double-digit decline in volumes for XPO. I mean, it's hard not to believe that they wouldn't have that. I mean, consumer, like we talked about earlier, consumer spending is way down, which they rely heavily on e-commerce. But that is, although they rely heavily on it, it's a good point for them moving forward through this COVID-19 thing.
It is. It's a very good point, and they won't see as significant drawdowns as other, especially truckload carriers. So we'll likely see in the second quarter. But I think consumer spending's down across the board. It is shifting. What is being bought is shifting more and more toward e-commerce, especially right now. And that's what his positive note in his letter was all about. But still that, it's almost like if it's 10% down, that's a positive note, which is kind of weird to say.
Yeah,
but
isn't it?
I think it could go that way. Yes.
There's one other point about Jacob's letter that I'd like to bring up, and that was really that his letter was very cautious, and he exerted caution that this was going to be a terrible year. But it was encouraging when I heard him speak about XPO's efforts to protect its employees and to ensure that supply chains were going to remain open to their customers. He made sure that he was going to take care of employees, they were going to do their best not to lay off anybody, and that they were going to ensure that the supply chains were open, especially for those for those medical supplies and the food that needs to get in to help frontline workers. I like you, Brad Jacobs. Thank you for putting that in there. And again, XPO really well positioned, like Kansas City Southern and like JB Hunt. They've got $1 billion in cash and a $500 million revolver that they haven't touched.
Yeah.
So a lot of liquidity.
Yeah, and then but they've taken their strategic alternatives.
Yep, that's true.
Off the
That's
table.
true.
They did that a couple weeks ago. We talked about it last week, right?
We did, yep.
That was last week, or is that 2 weeks ago?
I think it was 2 weeks ago we talked about.
Yeah, 2 weeks ago we talked about 8Ks and the filings of 8Ks, and that's something we will keep on top of as we move through earnings seasons. And basically we'll probably see a few more companies across all industries you've seen. If you have a credit revolver, any company that has a credit revolver or access to a predetermined credit agreement have been pulling those down, and those probably continue. XPO hasn't yet, but they're probably on the more safe side of credit facilities, credit agreements.
Regarding credit revolvers, it's either that if you need it, everybody is drawing it down, but if you don't need it, they go ahead and make it a point to say, we have it in case we need it.
Exactly right.
They're putting it in their earnings calls to say that we have a good liquidity position because we've got all this debt that we haven't touched, because everybody thinks that this is going to be a tough time. This is going to be a tough summer.
Yeah, and if you read Brad Jacobs' letter, he kind of reinforces it's going to be a lost year, so you need as much liquidity as possible to make it through it. And it goes back to PPP. PPP is all about liquidity. Having liquidity to keep your operations going, keep people on payroll. I think there might be a deal that they reached today, maybe already today.
I'm not sure.
For another $250 billion. That's breaking news. I can see it up here on the TV. So.
Gotcha. Well, Kevin, you want to discuss a little bit what's going on, the pricing power in the spot rate or in the spot markets and in the market overall. We have the DHL Supply Chain Pricing Power Index that came out last Thursday. We fell 20 points, Kevin, one of the biggest one-week drops ever, down to 25. Not quite all the way to the shippers, but about more than halfway of the power to the shippers. About
halfway to power to the shippers. 25, right?
Yeah, 25. So dead halfway.
Dead halfway. Okay.
Yes.
I was thinking balanced market.
Yeah, balanced market would be 50. We're at 25.
I mean, it's been very
volatile
over the last 6-7 weeks. We had 3 moves consecutively, 3 weeks in a row, 15 points. Got us up to 65, and has it been 2 weeks that we've got back down to 25 or 3?
Yeah, we had a 25-point drop and then a 20-point drop.
Yeah,
yes.
So I think we may go lower.
I think
we may go lower in the 2 or 3 weeks. I mean, basically, I know states are starting to want to open up, but that's still 2 or 3 weeks out. It'll take 2 or 3 more. So it's going to probably stay volatile.
Yeah, so let's talk about volumes a little bit. We touched on the Fuller-Strickland debate, whether they're going to be above 9,300 by May 15th. Right now, they're somewhere. I think they're around 8,600, which is it's looking like Labor Day volumes. But rejections are another thing. This is the lowest the outbound tender rejection index has ever been. It's at 3.51%, meaning that between 3 and 4 loads out of every 100 are being rejected. It's showing that carriers are pretty much accepting any and everything at contracted rates.
Yeah, and to put that in historical perspective, most of 2018 we were at above 20%. So more than 20 loads out of every 100, or 1 out of 5 loads were being rejected. Now, it's 3 or 4 out of 100, and those are historic lows. And Michael Vincent and I were talking about it earlier today on the coronavirus freight market update. And, it can't go negative. It can't really go to 0. I mean, I guess theoretically it could.
Yeah.
So what is the real, like full employment, right? Full employment isn't that everyone has a job. It's just statistically, the pool is maxed out. So what's full employment or full rejection?
Full overcapacity.
Full capacity.
Okay.
Yeah, full capacity.
I see. That's a good debate.
In the market, I mean, it's not going to be 0. Is it 2%? Is it 3%? I think we both agreed. I think we're pretty well close to that number.
Yeah, I mean, we've touched this. The 4% mark has been almost like a support line for this index of the last 3 years. It had gotten close to that 4% mark a couple times. It had dipped its toe below 4, but really hasn't been below 4 for a long time at any point in the 3 years. So yeah, I think you're right. I think we are getting close to that floor of what outbound tender rejections would actually look like at a full level. I think you're right.
Yeah.
And then spot rates. I mean, spot rates have adjusted to this dynamic. I mean, I was looking at
last year. Yeah.
Yeah. So last week when we did this, when I wrote the pricing power index, 97 of the 100 lanes that truckstop.com provides spot rate data for in Sonar were negative week over week. So all but 3, and the 3 that were positive were very short. There were 3 of the shortest. Like
lanes. Laredo to Houston, and there's a couple more that were Detroit to Chicago. I think was another one. So they're 3-4 hour drives. So very short hauls. That were the only 3 positive.
Yeah, so we will see where it goes this week. We'll be reporting that again on Thursday. I'm predicting another drop. Don't know how far, but I think the shippers are going to enter uncharted territories of pricing power dominance here for the next couple of weeks.
And I bet you they don't really want to either.
No, I think they'd much rather be
because those are going to be on very low
volume,
right? And like historically low volume. So I think they'd rather be in a hot market back in 2018, just trying to get trucks in there than have their volumes maybe slash 20-30%.
Yeah, I know I would. So Kevin, here we are. We have made our way to long short. I've got 2 for you this week. One is the first one is topping on to XPO a little bit, piggybacking off of our discussion about their good liquidity and their proven ability to make acquisitions. They've already made one this year that kind of surprised people. It kind of came out of the blue.
In the UK, right?
It was a European, a British company. Do you think that XPO makes another acquisition before this year is over?
I don't think so. I think it's a hard environment. It reminds me of the Great Recession where M&A just died. And I think it's going to be hard to attach a value to any business right now, especially a long-term value. I know the stock market does, right? But how accurate is the stock market right now? It's very volatile. So they can't really attach values to the company. So it's going to be hard, especially in the private market. If it is a private company, it's going to be hard to attach a value to anything. It's going to be hard to get credit for anything, even for XPO. So I'll go short that.
I'm long it. I think Brad Jacobs, I think he's an opportunistic guy. I think he sees, although it is difficult to value a company in this down market right now, I think he'll find a way. I don't know if it'll be a European company or American, but I think he's just sitting on too much cash. I think he's a busy mind. He's probably a little bored right now during this time. So I think he ends up. I think XPO does pull the trigger on something by the end of the year. And then the next long short is oil. We're going to talk a little bit about. I read an opinion piece in an Asian Times website that said that he doesn't think oil will ever reach the $40 per barrel again. I'll go a little bit higher than that. I'll say $50 per barrel. There are some other issues in the oil industry besides COVID-19, of course. Kevin, do you think that oil prices ever really fully recover? Do you think they get back to $50 a barrel?
Yes.
Okay.
No, you want to?
Yeah, I want the reasons, of course.
Basically, you're going to go into supply and demand. I know that peak consumption, all of that. Which I'm not going to disagree with anything you say about that. What I will say is that you have supply and demand, but it is kind of a store of value, like gold is. Like it's very much a speculative market, and I think that. It has a lot to do with the value of currencies as well. Like, the U.S. dollar is the reserve currency, but it has a lot to do with other currencies and kind of the relation between all of that. So I think you might get into some hyperinflation or inflationary scenarios. So, yes, that's my answer.
So you're saying you're long because of the thought that of hyperinflation, all of this liquidity, all this fiscal and all the stimulus. Okay.
It's a store of value.
Okay. I am going to go short, and you're right. I'm going to play the supply and demand card. I do think we're past peak demand. That was, I think, 2015 was our peak global demand peak for oil. I also think that there's an incredible oversupply right now. This is why the Saudis and the Russians got in the price war to begin with. I think that those issues probably persist for much longer than COVID does. I think this is going to be an ongoing issue between the Saudis and the Russians and the U.S. The U.S. is going to pressure the Saudis to push oil prices higher, while Russia says they can go with a $25 barrel of oil for years. So I don't think we ever see. I think that this COVID-19 may push us quicker towards the electric vehicle revolution that is coming. I don't know if oil ever fully rebounds to this $60 a barrel, what it was most of last year.
I've seen. I grew up in Oklahoma in the '80s during the oil depression there. I've seen it at talk of 150. I've seen it now close at negative $37 on a contract.
You've seen it all.
It'll come back.
Yeah, I mean there's no denying.
It might take decades, but it'll come back.
Oof, decades then. Well,
that's
we'll keep that debate going next week. But let's talk a little bit about what we got going on the rest of the week. Freight Intel has a paper that just came out last Friday. It is the Q2 freight market outlook. We give our outlook for intermodal, for trucking, for maritime, air, everything all in one place there. You can find that at freightwaves.com/passports. And then we also got, what do you guys got coming up on Put That Coffee Down tomorrow at noon?
We had, Tuna and I have how to not fall into that price trap with shippers, whether you're a carrier or a freight broker, how to defend your prices, how to build value. And it's going to be very interesting because, basically with volumes, it's like a race to the bottom. Everyone's underbidding everyone else. But how do you get out of that game and get into a game of building value for your customers? So it'll be an exciting show.
Yeah, that'll be great. You got any guests on tomorrow?
We do. Ryan Schreiber from Carrier Direct.
Hope he hasn't cut the beard.
I hope he hasn't either. And Carrier Direct is a great partner for this show. And a great contributor.
Shout out Diane, CEO.
Yes.
She gave us some research for this. And then for the rest of the week, we got Freightonomics coming up tomorrow with Zach Strickland and Anthony Smith. That'll be at 2 p.m. And then we got a coronavirus update then on Thursday at noon. And What the Truck finished the week off at noon on Friday.
And then tomorrow at, I think, 4 o'clock is with Sonar. With
Sonar, that's right.
With Luke.
With the Miami boy.
Yeah.
And the Miami boys.
And Kyle Taylor.
Luke and Kyle Taylor will be
the Sonar
Sonar
executives.
Well, good stuff, guys. This has been The Real, episode 25. Our milestone is now officially in the books. I thought it was in the books last week, but here we are passing episode 25. We are on a 6-day, 23-hour break.
Yep.
See you next week, guys.